Hi, my name is Sergey Savastyuk, and today I'm going to try to make a case that in 2025, you better be trading rather than investing. And I have a lot of reasons for that. Why? Because the previous 2 years been enjoyable years, about 15 to 20% passive return. You have nothing to do. Market kept growing, and then you didn't need to apply special strategies to achieve those returns. What I'm going to do is to make a case that this year, maybe the next 10 years, we are not going to be providing this type of easy life. And then please don't tell me I didn't warn you. Okay? Okay, let's start. My name is Sergey Savastyuk, and here is our legal information and all disclaimers you can find on our website, tickeron.com. And here is the content. So what I'm going to claim, and I will show you some other studies which expect about 3% return 2025 and maybe the next 10 years. So this is going to be the market, and you might end up at the end of the year with pretty much nothing, either negative or nothing. And there are a lot of cases for that. We're going to look in the history, okay? So what is going to influence this type of a behavior? As you can see, imposed tariffs is at the very end. It is not a real reason why markets are going to go down and are going to fluctuate like that. Okay. So what are the macro volatility indicators this year? It is economic uncertainty, chances of recession about 60%, valuation problems, and labor market. Okay. So then I'm going to look at the stock market indicators, which are leading indicators for the purposes for you to really look at these indicators and understand the overall trends on the market for the months. And then when you know the trends for the months, then you can trade better. So we're going to look at the housing market, treasury bills, and gold and silver ratio. And only at the very end, as I said, we're going to look at tariffs and the technical aspect related to VIX. Okay, and then I will show you how we deal with this type of uncertain markets. Okay, let's start. As you can see, this chart is credited to Goldman Sachs. What they did, they analyzed what has been happening in terms of average returns over what it's almost here is 100 years. Okay, so look at what the periods were not far from not long time ago. Let's say after 2000. You see, this is the chart where the expected returns were either zero or negative or three or something like that. So there was a quite a long time after the bubble crash. Okay, look what was happening after another crash of 66, and then doesn't provide the analysis to the 1930s, but that was the case when public was disappointed with the crashes, then it was not returning to the market, and then we see this type of returns. Okay, so now, as I promised, uh, let's look here. So as you can see, the expectation is about like here. You see, baseline 3%. This is according to Goldman Sachs. Okay. Economic policy uncertainty index. So some people calculate, as you can see, the level of uncertainty equal to COVID pandemic time. And you remember what happened with the market. Okay. So there is another recession type of calculator. As you can see, some people betting money on the recession, and it is 60%. That's pretty high. Okay. Now I like this chart because I introduced this chart first time at the end of November when I said it's going to be AI bubble bursting. We're right here and started bursting right here. So when I published this chart, it was just the beginning of the March, the worst month, and it turned out my prediction ended up being right. So what we see here, it is the internet bubble crash, then it was a financial markets crash, and it is the 1929, right before the depression. It was pretty big bubble of the stock market overall. People were excited to buy and sell, and that's what happened. Okay, so as you can see, with regard of the PE ratios, we pretty much at the same level, and that's what we see. What's going on? It's nothing to do with tariffs. Okay. Now, next one I promised is the labor market. Okay, look at what's going on in terms of announcements of the cuts. Okay, so as you can see, it's right here, and this is the pandemic time. This is the financial crisis, real estate crisis, and this is the internet bubble crash. Okay, so as you can see, every time there is something, there are these indicators, this one, this one, this one, this one, they all show what is going to happen. As you can see, this is the financial crisis. It is the expected change in unemployment. As you can see, the chart shows the similar behavior in employment to the financial crisis 2008. Okay. So another kind of analysis is again about the employment. As you can see, every time gray area is a recession, every time there was a recession, employment went down. As you can see, some people already believe we are in recession, but there is no data yet. And at this moment, that's what the chart looks like. We will see in the months to come, maybe already been into the recession, but we will see. Every time when there were corrections not related to the drops in employment, then these corrections were fixed pretty quickly, but we will see what's going to happen here. Okay, please watch it. Another macroeconomic type of indicator, it is expectations of the housing market. As you can see, this is the chart where single family homes for sale. As you can see how many were for sale in 2008, and then it is a recession, and it went all the way down. And as you can see, number of houses for sale, pretty high. Houses are not being sold, and that's another leading indicator. As soon as people cannot sell the houses, then home builders cannot build new houses. As you can see, what is typically happen right before the market crash, the leading indicator, this is the stocks of home builders. If you're going to watch them, you're going to know several months in advance if there is any recovery, okay? And this is overall home building index. As you can see, pretty low, equal to the data 2008. And this was also another recession time when these numbers were pretty low, okay? So this is a household liquidity expectation. So this is also interesting chart, which shows that if people are not having liquid assets, then they cannot put them into the market. And as you can see, that a yellow line, it is expected returns, and the blue line is a non-equity assets. And you can see this non-equity assets pretty much zero. So that means 83% correlation. And what's going to happen similar to this case, so that means this yellow line for the next 10 years are going to go down, okay? And the yellow line is S&P 500. So that means another confirmation of pretty bad years to come, okay? Another indicator So let me go back. As you can see, I covered labor market. Now, let's look at the stock market indicators, which is somewhat deeper inside of the stocks, which you can use on top of the macro volatility indicators, okay? So let's look at the treasury bills, treasury yields. What happens every time the economy went down, the treasury yields are supposed to go down. What's going to happen this time? Nobody knows. There are some rumors, Chinese buying treasury bills, and then it's going to be pretty bad for the government to refinance. But as you can see, if it is normal, then the yield should be somewhat in this box. And inflation means the interest rate goes up. Okay, recession goes down. You see, every time yields are going down, then we are pretty much in a recession. Okay. So next leading indicator is the ratio gold versus silver. Okay. So what happens that silver used in the production of a lot of electronics, gold too, but when that ratio goes up, so that means there's a lot of uncertainty on the market and the people jumping into their safety. And as you can see, pandemic time was one of the highest numbers. And as you can see, April 2022, as soon as this ratio goes up, then there is a problem on the market. Okay, so watch gold to silver ratio. Okay, as you can see, this is a really nice chart. Gold to silver ratio goes up and market goes down. Okay, and when market goes up and the ratio goes down. Okay, and then gradually this indicator is leading indicator because it kind of suggests what's going to happen next. Okay, so that means, look, I covered for you really good stuff related to overall understanding what's going to happen, okay, and some historical comparison which are nothing to do with tariffs. Then I showed you what's happening with the housing market, with the treasury bills, gold silver ratio. Now let's talk about the tariffs and the technical aspects of the market and the VIX as an indicator. Okay, so now tariffs, boom, and today is the April 10th. We have a market like that. It went up, down, up, down, up, down. For the months it was down, then it was big down, then again up, and again down. Okay, so that's what is happening, and it's all about Trump, right? So as you can see, some of the tariffs never been imposed for the last, like, I don't know, 200 years or so. This is a pretty big. And as you can see from the historical perspective, there was some tariffs were imposed in 1930s. And as you can see, it's somewhat similar. If we look at this chart, it's supposed to go down. This is a chart of S&P 500 1930-31, and it kept going down. That's what I'm talking about, okay? And this is a Liberation Day, and we see the big drop, and then it's going to be fluctuating. And please don't tell me I didn't warn you, right? Okay, so now what's going to be happening? We're going to constantly see ups and downs, ups and downs, ups and downs with the overall trend down. Okay, so instead of looking for the buying opportunities, you should be looking for the selling opportunities right here. Okay, how? You have to watch for the VIX. VIX is a volatility index. It's being traded. You can always find it on the internet. And if it is about 35 points, then it's pretty high. Okay. So overall market is trending. That's when you can make money, when it is below actually about 20 or even 18. That's where the trends, good trends are. And this is a pretty bad case if it is about 35 or higher. As you can see, it is the pandemic time. This is the financial crisis time. And if we put it into the drops, then exactly when this number is very high, typically it is a buying opportunity, but this time nobody knows. So that means I'm advocating again, be careful with what's going to happen this year, and don't rely on the concept buy and hold. Okay. So let's see what else I promised to tell you today is inverse ETFs. Okay, so how we deal at Tickeron with inverse ETFs? We use them in our AI trading agents. We build robots and apply them in a double agent, so-called, right? So what we do, we look at the stocks, ETFs, which go up, and then opposite direction, some inverse ETFs. You can look at the internet what inverse ETFs are, but they actually go down when the particular stock or index going up. And opposite, when the stock goes down, this one goes up. So that means if you properly make a sequence of events, then you don't need to have a margin account. It's enough to have long positions, all of them always long. And that's the thing we are developing here at Tickeron. So we also provide quite a lot of pages related to stocks, ETFs, mutual funds. We provide different tools like stock real-time patterns. We provide tools related to the pattern search engine and screener. We have a lot of information related to earnings calendar and buy and sell daily signals. And by the way, we're running right now limited time offer where you can buy subscription for one robot, for one agent, but actually have access to all of them. That's a kind of a really introductory offer, and it's gonna be over soon. Okay, so please visit our website. Please visit our Twitter. Please visit our information on our channel, YouTube channel. We have a lot of stuff going on Facebook. Welcome to our channels and to the Tickeron. Quite a lot of ideas here we're publishing at Tickeron for free. So you come here and actually get quite a lot of stuff right here at Tickeron, at Twitter, or right now X. That's about it. Hopefully you enjoy the presentation and you are warned and you have enough knowledge to understand what's going to happen next year. Thank you and goodbye.